What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market, notably some monthly charts there. After that, we've got our core list of companies, and if you stick with me towards the end of today's video, I've got 9 additional trade ideas to share with you, so definitely stay tuned for that. 9, can you believe it today? As always, anything that we are associated with is linked down below in the description, and without further ado, let's jump right into the charts. So kicking things off on the SPY monthly time frame, talking about candle structure and location as we always do. For structure this past month, we certainly have a large red-bodied bar with a sizable upper wick on top. That upper wick would indicate the absolute failure from the buyers to get any price acceptance within the prior monthly range right here. The most defining characteristic is the close really weak down on the lows of the monthly range, and that of course would indicate to me that from a structural perspective, sellers are firmly in control here. If we think about location on the bar-to-bar count, we do have a significant lower high as well as a significant lower low. That is a bearish data point. And we've also got a new monthly closing low underneath what we got from June, another bearish data point. Something to be aware of as well is our Fibonacci's coming in from the sickness low all the way on up to the high here. What you'll notice is that we've failed to hold on to the 38.2, so no longer is this putting in beautiful, healthy bull flag consolidation. The breakout of the flag would seemingly be off the table based on the breakdown of the 38.2. And instead, what we're headed towards is the 50% retracement, which is sort of aligning nicely with this prior market top here, as well as the blue line on the chart, which is the monthly 50 SMA. So we do have confluence of supports underneath us from an indicator and structural perspective here. It's something to be mindful of, but it certainly does not guarantee any sort of upward bounce. So again, it's an awareness thing. Know that those things are there. If we do produce an upside move, so be it. If we flush right through them, also do not be surprised for that. The market is extremely volatile right now, which we will continue to discuss. And again, you should just keep your expectations very, very low and open to many different possibilities in the marketplace. So that is the monthly time frame chart. And I suppose before we go any further, let me just grab like 20 years and show you the 50 SMA in a bull market cycle traditionally does tend to offer some support, right? So just noting that we're coming into that. Again, no guarantees, but something to be mindful of. Let's go ahead and drop it on down to the weekly time frame chart here. And what we'll do is talk about structure, location, the same thing, obviously, and actually, quite frankly, this is almost a mirror of the monthly bar, right? So the upper wick indicating very little price acceptance in the prior weekly range, a close extremely weak on the lows, indicating sellers are in control. From a location standpoint, obviously we've got the significant lower high as well as lower low, and we've also closed underneath the weekly 200 SMA. From the June low, I mean, we talked about it on the monthly, right? But still, we've got a weekly close underneath that level as well. So sellers do appear to be in control on the weekly time frame chart. But before we get ahead of ourselves, I would also point out that we've gone through the 100% retracement with no dead cat bounce. Now we're a little bit extended through that quote unquote floor without some sort of reprieve here on the weekly. I would just suggest that if you're looking for new money swing shorts, you probably want to wait for better structure here on the weekly time frame. This to me feels like you're chasing it on the lows with poor trade location, just something to be mindful of. The next thing I would point out before we drill it down to the daily would be the volume profile. So high volume node here has obviously been long violated. That was our 390.85, well underneath that. There's a little bit of a bump out here, and that was really the consolidation from June lows. We're obviously underneath that as well. So looking left, obviously, not looking great. We've got a big void until we basically get back down to the pre-sickness highs, roughly 340. Again, this is not a suggestion that we go there this upcoming week, just pointing out that from a volume support perspective, there's not a whole lot underneath us until we make that quote unquote great reset to the pre-sickness highs right around 340. That's the weekly time frame. Let's drill it on down to the daily and start talking about tradable levels and what we're sort of expecting for this upcoming week. And there's the drawing set. So 50 SMA in blue, 200 SMA in green. Let's first discuss the weekly expected move here. So in last week's episode of the weekly watch list, we talked about the possibility for range compression after seeing some pretty significant expansion through this phase right here. And that's exactly what we got up until Friday, where we did start to break down underneath the bottom of this range. All I'm getting at is that we did move towards the bottom end of last week's expected move. This week's expected move would suggest that we remain in a downtrend, because if we rally to the top, obviously this produces a lower high underneath this yellow gap from right around in here. And obviously this is pretty self-explanatory as well. A move to the bottom is just a big lower low for a trend continuation, which is clearly bearish. So weekly expected move is bearish from that perspective. And I would just also point out that we've got a similar range in terms of actual distance here to last week's expected move. It's roughly 12, what is it? I'll just give you the exact number here. On SPY, we want to focus on this one, $12.06. So $12 up, $12 down is the expected move, very similar to what we had last week. And I'm pointing this out to just reference that the market is starting to see the amount of volatility in the sort of marketplace, right? It's finally being priced in the options chain. So all good. Weekly expected move is bearish. From a levels perspective, let's talk about the balance area from basically all week, barring Friday, right? On Wednesday, I will fully admit I was a little bit more bullish than I should have been. So right now, I'm just trying to be very objective and reactive to this market. I don't want to sort of carry forward those same ideas and thoughts. It doesn't mean that we can't have bullish outcomes this upcoming week, but I just want to be very objective about this. So here was a balance range. We failed to get any acceptance underneath it multiple instances on Friday. We even rallied back into that range, but look at how we've closed. Firmly to the downside. We've adjusted our levels just a little bit based on the intraday reversals, and the main pivot I would want you to focus on for the bottom of this balance here is 360.75. So going forward, because there was a failure to hold above that, and we obviously moved lower outside of the balance range, anything that remains underneath 360.75, in my estimation, bears are in control. Even if we get a dead cat bounce early on Monday, but all we get is the move to the back test 360.75, if you see any signs of weakness there, given that every other data point we've looked at thus far is bearish, it wouldn't be unreasonable to look for shorts with a tight stop right above the level, right? Now, why are we using a tight stop right above? Because if we think about balance rules, what is the other outcome that can happen here, right? If we move back into the range, then once again, we've got trapped sellers who have, seemingly ran out of bullets multiple times throughout the course of the week. Trapped sellers close out. That's a look below and fail, and we target the top of the range, the top of the weekly expected move, just the top of the balance range. So that is a bullish outcome for the upcoming week, but it's not bullish in terms of the weekly structure or monthly structure by any stretch of the imagination. As a general rule of thumb into the upcoming week's worth of trade, anything that does not get above this gap here, sellers, yes, in control. So even if we do something like this, I would say, we're not really making all that much progress in the bullish direction if we can't get into and over that gap from in the past. Just to give you the numbers, it's 373.45 down to 370.65. Downside levels, where are they coming from? So we've got 355.25, 352, 347.50. Where are those numbers coming from? Obviously, we've got to get quite a bit of data here before we can start looking at chart levels from the past. What do we want? We want 5 years. That's good. So zooming in just to show you where they're coming from. There should be no surprises here on the channel. Zooming in, you can see that we had a big gap up on the red day. When we pulled back, we support once, support twice. That's your 352. 2 days of balance that held up over this sort of nasty inverted hammer. That's your 347.50. And the little support from in here is 355.25. The 338 is the reset, if you will, to the pre-sickness highs, which again, I wouldn't suggest happens this upcoming week, but just a level I want you to start preparing for here on the daily time frame. Going back over to the recent price action, let's give you a couple of Fibonacci perspectives here to at least consider, and then we'll move on into the sectors. So doing something like this. There we go, front and center, Fibonacci tool, there it is. So coming in from the FOMC high, right, because we did get a little bit of an intraday rally there before falling apart, and that really spurred this downside leg. Moving to the downside here, the low of Friday, notice that your 38.2 from this Fibonacci perspective is also aligned with the top of the balance range. So even if we rally to that, we are still just building out bear flag consolidation from the Fibonacci perspective, which is obviously something I want you to be aware of. And then also coming from the last rally high to this new low, the Fibonacci is nowhere even close, right? The 38.2, and we're still in bear territory as long as we're underneath that. So as you can see, there are quite a few bearish data points stacking up, but I would just remind you, be mindful of the look below and fail. That would kind of trigger on the weekly time frame a little bit more digestion correction in my estimation, and you shouldn't really be pressing the bet too hard to the downside if this happens early on in the week, a move back over 360.75. I know I just said I wasn't going to be overly bullish, but it's a scenario I want you to be mindful of. As we pointed out, anything that remains below, fine. Bears, run away with it. Please do your thing. Give us some tradable trending action. All right, that has been the S&P 500. Let's take a look through the sectors that comprise the S&P 500, and then we will move into the remainder of the presentation. So real estate, what's going on here? Obviously a nasty hit to the real estate sector, big move to the downside. This floor kind of has to, quote unquote, has to hold. Otherwise, things will continue to get nasty in the real estate sector, and it will carry more weight than it actually carries, right? So if this is making new significant strides to the downside and it's such a lightweight sector, I would read into the fact that the move is so significant that, okay, maybe we should pay attention to this a little bit more than we normally would just because it's a lightweight sector. So hopefully that wasn't too confusing. I'm just pointing out that, the big move here in real estate to the downside is kind of concerning for the marketplace. You really want to see it start to support around this 34.75. And obviously this has a lot to do with rates, which we will discuss as we move through today's presentation. Next up is the energy sector. Obviously a little bit stronger just based on a overall trend being still up here. But in the more nuanced minutia of what's going on, certainly watching this gap overhead, right? So 73, if we can break out over that, we are looking for some upside in energy to close the gap to 75.60, and the pattern does look bullish, right? If we look at what's going on here, we've got lows, higher lows, flat top. That's kind of like an ascending triangle, little digestion doji on Friday instead of being bearish and breaking down like the rest of the market. So some relative strength. If we take this out, look for the gap to close. And when and if we get here, that's where I would look for the reversal and the lower high to be put in on the daily time frame chart. And you'll see that, we can actually have some actionable setups to take away from this because we've got Conoco as well as Exxon on the trade ideas list for this upcoming week. So that is energy. Next up is utilities, falling off of a cliff as well. It's kind of cool looking at these charts zoomed out. We haven't done that in quite some time. Still a decent uptrend, but I would start to say that, this is turning more into a broadening formation. Notice how those two lines are slightly diverging instead of converging. So broadening formation gets kind of difficult to trade once you start snapping these. I would say the critical support you want to watch out for is roughly around 63. This thing has fallen off of an absolute cliff. Remember that it is D for defensive, so it's fine to see it lower, but enough's enough, right? At some point in time, as we point out, downward pressure is still downward pressure for the S&P 500. I would love to see a bit of a dead cat bounce off of this 64.60 to sort of neutralize the market. That would make sense to me. If we see a move back over that SPY bottom end of the range, I would look for utilities to do something like that. Next up, we've got the XLP. What's going on in staples? No, not Staples, the store. We're talking about consumer staples, obviously making a new move underneath the June lows and sitting right on pretty historic support around 66.50 coming from prior rejection points and just a whole lot of touches in this general area. So I would expect a dead cat bounce possibly. If we do just get trend continuation to the downside, it's all about this double bottom around 64, which would obviously be bearish pressure for your S&P 500. Overall, the chart does look like it's struggling here. A really weak close on the lows of Friday, but kind of sitting right on that big support that we saw when the chart was scrunched up. So be mindful of that. Dead cat bounces will likely produce a lower high. So I'm not saying we're bullish. I'm not saying we're out of the woods, but a little dead cat bounce wouldn't be a big surprise to me if that were to take place. Next up is the XLK, the tech sector. What's happening over here? Certainly breaking down from a multi-day balance, right? If we zoom in, a little bit more similar to the S&P 500, but not quite, right? So here's a balance. Thursday actually broke down first. Friday got some follow through, right? We tried to make the attempt back above that 122.20. No dice in the tech sector, and a new closing low underneath the Thursday bottom. That does strike me as a bearish outcome. We're breaking down from a multi-day range. Can we see some trend continuation here? Yes, right? It's not like this is as extended as what we just saw in utilities as well as consumer staples. So down underneath us, we've got 115.50 down to 114.15 is a daily gap. If we just throw this on auto and scrunch it back up, we can illustrate that. Zooming this thing way out. There you go. Prior gap, and then this double bottom is a very important level around 109.65. Again, not suggesting that we go there this upcoming week, but starting to prepare for some downside levels if we continue to see the amount of volatility that we are currently seeing in this marketplace. Next up is the XLV. What's going on in the healthcare sector? Remember that this is the second heaviest weight by market cap, and what we talked about last week was the failure to do anything impressive on the backtest of 125. So this does strike me as a pretty bearish outcome here in the XLV. We have a look above and fail. We did target the bottom end of the range, so that trade has been fulfilled. And now it's kind of like, all right, if we break down underneath, obviously you've got kind of the bear flag look. Some people call it an H pattern, right? And you're looking for at least the June lows. We have not made it yet there in the XLV, the healthcare sector. So is this going to play catch up and get there? Certainly seems like a possibility. And being the second heaviest weighted component of the S&P, that of course spells downside movement in the SPY itself. Continuing along, we've got the XLC. What's going on in communications? This is the one that had fallen off of a cliff first. We know that the prior balance range was way up here, way extended, but look at what's going on, right? We're getting some sideways price digestion, which actually does set up now reasonable short entries. Let me talk about the fact that on Wednesday, right, we technically got a close. Let me make this a little bit larger, easier on the eyes, front and center. There we go. So on Wednesday, we did get the close over the two highs from right around in here. And then look at what's happened, right? An absolute failure on Thursday and Friday. We test the top again, no acceptance, immediately slapped back lower and close underneath the low of the balance range. So bear flag seems likely to me to pan out to the downside, giving us some bearish pressure in communications, taking us closer to 46.40 on the downside. If it pops back into range and just consolidates, fine. Wouldn't really want to touch it in the consolidation zone. Only if it breaks out and gets a significant move over Wednesday's closing price, 49.70, would I start to say, okay, maybe there's something to do here on the long side to retrace some of this thin structure. But patience, patience, patience. This chart does strike me as a big failure from the buyers, and sellers starting to take some control underneath the bottom of what is seemingly looking like a bear flag. Next up is the XLI. What's going on in industrials? Zooming in over here, this one also falling off of a cliff, but putting in a decent little consolidation range at the bottom. So I'll just echo the same sentiments that we just talked about in communications, and we have a gap underneath us from 83.35 down to 81.65. Be mindful of that. Virtually no structure in that gap territory, and then the prior highs and small little support from right around in here, 80.10. Again, think the same thing that we just discussed in communications and apply it to this balance range right here. Next up, we've got the XLF. What's going on in financials? Let me do the same thing. I'll echo the same sentiments. There's your bearish range, bear flag. We have the failure from Wednesday. We've got the test on Friday right at the highs, rejecting and closing very weak down on the lows. So if we take out the bottom, this one's not all the way there yet. This could be a breakdown trade early on. Hint, hint, that's why we have Morgan Stanley on the list, right? And SQ even as well, although it's not quite, it's a fintech, right? But you get the gist, right? If financials break down out of this flag, that's where we're looking for a move lower to bring us closer to 29 in financials. There's not a whole lot of support underneath us in financials, which is fairly concerning because in our lineup, this is the second heaviest weight by market, not by market cap, but this is, again, in our lineup, second heaviest weight by market cap. Wow, I'm getting all sorts of confused. Maybe I should just slow down here. What I'm trying to say is financials are the second most important thing we look at in our lineup. The XLV is the second heaviest weight by market cap. That was a tongue twister. If you tuned out because that tongue twister, then I don't blame you, but let's continue along anyways. So XLF, boom, balance range, taking out the lows. That does strike me as bearish, and we've got quite a ways to fall. Significant, right? Second most important sector that we pay attention to in our lineup. XLV is the second heaviest weight by market cap. Just had to do it again to really prove it to myself that I understand what I'm talking about. Anyways, XLY, what's going on in consumer discretionary? Nowhere near the June lows, still continuing to exhibit relative strength, but notice what's going on the Friday session. So there's your balance range. Friday is an inverted hammer. We tested a move back above. So at first, yes, this was looking like a look below and fail. Never made it to the top of the range. Where did we close? We actually expanded range to the downside into the bell, outside of the balance area from right here, which does strike me as a bearish outcome. We're looking for some follow through to the downside. It's day one of the breakdown on Friday, so this could easily continue. I am not worried about this one being extended. This is also a fairly heavy weighted component of the S&P, so it's important to keep an eye on this one. Next up is the XLB materials sector, really lightweight sector, not nearly as important as the XLY that we were just looking at, but what do we see going on over here? Little balance range, inverted hammer from the Friday session, look above, failed back in, so can we move to the bottom of the range is the question at 67. Again, lightweight sector, not going to make or break your S&P 500 overall. You want to watch your XLK, you want to watch your XLV, XLF, and XLY. Those are the big four that I would really start to focus on this upcoming week. Here we go, ratio grid. What is this? Well, if you don't know what it is, check this video out in the top right-hand corner, and let's get down to business. Top four are the risk-on sectors. What do we see in the XLK? Continuing to fall off of a cliff. This is the biggest thorn in the side of the S&P 500 on a relative basis. The heaviest weighted component is underperforming, which is, of course, bearish. The XLV is actually hanging in there. It's making a move higher, but what they don't know is that obviously we had the look above and fail. We failed 125, so this to me is not really out of the woods yet. XLY looks okay. That, seems appropriate to me given what we just saw on the chart. And financials, if we break down, that's where this probably just starts to go sideways, if not lower. So we're not nearly in a risk on state. Obviously, that's should be pretty straightforward at this point in time. Bottom four, what do we see going on down here? XLP kind of just neutral, so not really risk on or risk off. XLE, energy perking back up, looking a little bit more risk off than what we had as it was making this downturn here. Real estate falling off of a cliff, that goes without saying. And then the utilities sector, let's see if it produces a bounce off of that gold line. That's the 50 SMA, and that would be more of a risk off indication. So far, we're not out of the woods from a risk on, risk off perspective, even though some of these charts here do look okay to the upside. This is really the concerning factor, as we know. So those are the ratios. Let's take a quick peek at the TNX. Here we go. This is the 10-year interest rate, and this thing continues to shoot to the upside. If anything, this is starting to look more like a bull flag, and we can see higher rates. Remember that the rough relationship with rates and the market is that as rates continue to the upside, market does not like that. This impacts tech being the heaviest weighted component, drags the market lower. So if we see more upside, that is not good. I would expect more downside in the overall market. If rates start to come in a little bit, which again, nothing about this trend or pattern would suggest that, but if they do, and we see something like 3.4 again, roughly this prior high and this little congestion zone from in here, market probably likes that. Now there is a scheduled meeting by the Fed, an emergency meeting I should say, scheduled by the Fed for Monday, I believe. I don't hold me to that. We'll of course cover it on the pre-market live stream, but it's something to be aware of. Is the Fed going to step in and say, oh my goodness, we've completely destroyed the market. We've got to artificially start probing at things almost like the British Central Bank did? It's possible, but I would say that there's a lower possibility of intervention just yet before something massively, bad happens, like a big flush in the S&P 500 that takes us lower than the pre-sickness highs. That's kind of where I imagine, okay, they start to step in and maybe they do, yield curve control, where they sort of support the longer dated bonds and sell the near-term bonds, right? So we'll see, one step at a time. Don't want to get too fundamental on you, but yield curve control could be coming down the pipeline, and the Fed scheduling an emergency meeting here. Maybe that's an indication of what's to come. Maybe they think they've gone too far. I have no idea. Just be mindful that this ties directly into volatility and headline risk. So noting that, let's take a look at the VIX, right? Because we don't know what the Fed will say. We can speculate all day long, but at the end of the day, it's just unknown volatility on the horizon. So what is the VIX telling us? Obviously, we are still elevated and we are accepting these higher elevated prices outside of the breakout from here. So are we out of the woods? Absolutely not. If we are going to see a capitulation type bottom at this point in time, again, remember what we've been discussing. It probably is going to take, S&P going at least to 340 if we see a 40 read in the VIX itself. So quite a bit of downside could still be in store based on what we're seeing in volatility accepting in these higher ranges. What about the volatility of the volatility index? Here's the VVIX. Taking a look, you can see that hedge funds and, money managers are still accepting that there is risk on the horizon. People are buying VIX calls, people are buying SPY puts, and that's why we're finally elevated and spending some time above 103. We are not out of the woods from a volatility perspective. Let's go ahead and take a look at the /VX for the volatility futures and just check in on our backwardation here. So going down a little bit, what we want to compare is the October contract right here at 31.32 to the November at 30.83. That to me is still inverted, right? So volatility is indicating that here in the present day, there's a higher degree of risk that the world might end now than there is in November. So the market is seeing the risk out there, which is what I was sort of hinting at earlier on in the video, that, just because we have a monthly 50 SMA underneath us, just because we have the 50% Fibonacci, we've got the sort of prior pivot high there, doesn't really guarantee anything when you're seeing volatility readings in the sort of, really elevated states that we're seeing in this current marketplace. And knowing that, I think managing your expectations in this current market environment is paramount. And that also brings it full circle to what I was discussing about being probably overly bullish on the Wednesday video. So a little bit of self-awareness here, trying to bring it back home. Let's take a look at our internals and see what's going on from that perspective. So here we go, NYSE internals, top right-hand corner is a little tutorial on how to set this up, what it all means, and some of the interpretations. So anyways, in the volume reads, notice that, and if you were paying attention on Thursday was absolutely horrific. Our breath bubbles here, the ratio, was reading at times like -50 to 1 outflows of the market. Yet Thursday was the day where we kind of went sideways, and Friday was the day where we sold off. Now look at what happened with volume on Friday. It really wasn't that bad. It didn't get to that negative 300 million mark, which might run contrary to what you believe based on the whole theory of quote unquote window dressing for the end of the month, end of the quarter, whatever. I don't really subscribe to that too much. I'd rather just look at the hard data in front of us, and this would certainly suggest that it was not nearly as bearish on Friday from a volume perspective as what we saw on the Thursday session. What do we see in the advanced decline line? Same sort of idea. Massively overcorrelated states, another indication of volatility, had corrected on the Friday session. Right? So that to me is kind of a head scratcher. It doesn't guarantee that Friday's move was a farce. It doesn't guarantee that we move back inside of the daily balance range on the SPY and move to the top there, top of the weekly expected move. It doesn't guarantee any of that, but it does start to raise some questions. What's going on from a tick perspective, right? Across the entire New York Stock Exchange, the tick was fairly flat on Friday. Even though we sold off aggressively into the close, the cumulative tick did not register any significant negative 5,000 reads at all. So again, kind of a head scratcher. And, it's probably just the heavy players, really Apple, right? Apple took kind of a beating there on Friday, that are causing this market to come in. So if Apple bounces, maybe the market bounces, right? That's kind of what we're interpreting from these data points right here being slight head scratchers, okay? So that is the internals breakdown, and I would say all it's telling us is that, yes, there were some significant outflows, there were some significant inflows on the Wednesday bounce day, but on Friday, as of Friday, things have kind of neutralized a little bit, so we're accepting of any new trends that start to build out. What do we have going on from the market profile perspective for the ES? What I want to point out here is the spike from Friday afternoon. So if you don't know what the market profile is, I've got a tutorial video for you in the top right-hand corner. Check that out. It's going to describe some of the terms that I'm about to use. A spike is a string of single prints right there. That's how we closed on Friday afternoon. There are three outcomes when dealing with a spike. Do we open above the spike, in the spike, or underneath the spike? And each one of those outcomes has particular rules. If we open above the spike, I'll give you the number in just a second, I would expect that anyone who went out short on Friday gets squeezed. They are feeling pain as soon as they wake up on the Monday morning session. Maybe that provides the look below and fail on the SPY daily time frame. If we open inside the spike, this is kind of scenario number 2, this is scenario number 1, right? If we open in the spike, I would look for two-sided trade back and forth, and then as we get price acceptance, the next move should be produced by either taking out the spike high or taking out the spike low. So pretty tradable levels to go based on. The third outcome is opening underneath the spike, which would indicate that we need to auction lower until we find new buyers. Of course, you're just looking for continuation if we see a gap down on the Monday morning session. Again, would I short it? Probably not, but the market's trying to tell us we need to, auction lower until we find those buyers. What are some interesting other takeaways from the market profile? What did I say? I should have said one of the other interesting takeaways from the market profile. If I could get this to show the letters. There we go. So here's kind of the daily balance range, right? And notice where the point of control was on Friday and Thursday for that matter, right? Just a hair underneath. Right, just a hair underneath. It's not like the point of control migrated all the way down here with price into the close. So that's an interesting takeaway. It, to me, would just tell me that the market's really more comfortable hanging out in this zone as opposed to at these new lows. Now, it doesn't mean that we can't migrate it lower over the course of time, but on Friday at least, the most volume was actually up here. The last takeaway from the market profile that I want to share with you is the fact that on Friday, we did absolutely fail to accept in the Thursday spike, right? So it works both ways. As we move into the spike overhead, we think of that as an area of thin structure, no acceptance, immediately back under. It makes sense that the market did rotate lower after failing to get any acceptance in that spike from right around in here. So pretty cool stuff. And again, the main takeaway is just use these numbers. So what are the numbers? I just realized I didn't even tell them to you. Here we go. What are the spike high and low? Spike high, if we zoom in way in on this thing, spike high is going to be at 36.1250. Spike low is just Friday's low of day, right? At 35.96.25, okay? So those are the two numbers, 35.96.25, and our upside is 36.1250. Okay, those are the two numbers for your spike in the ES. Let's go back on over to the platform here and take a look at one last chart, then we'll move through the remainder of the broad market. What's going on in our SPX A200R? This is the percentage of companies trading above their 200 SMA, basically an oscillator that gives us an idea of whether or not, stocks are generally sold and really beaten down, or things are kind of more neutral. So This yellow box represents kind of where we've had some data points in the past. And what I want to point out is that the only thing that we have comparable to what we're experiencing right now, a lower high at the top of the box, is roughly what happened in '08. Now, granted, the lower high was not at the top of the box. It was slightly higher at the 50% mark. So I'm not saying it's going to be the exact same as 2008, but this would suggest that we can see a move lower. This is kind of your, oops, where's 2008? There it is. There's your '08. There's your '08. This could produce a little bit more downside. All I'm getting at is that, over a couple of months, we actually remained really depressed in really oversold levels in the SPX A200R. So again, in terms of managing expectations, it wouldn't be unreasonable for this to continue lower and to see some more downside in the S&P 500. I get it. This is more of a higher time frame perspective. I probably should have included this at the very front of the video, but you get the gist. It is worth paying attention to. And this again is the SPX A200R. With that being said, let's go back on over to our standard layout and we will start discussing the QQQ and the remainder of the broad market. So monthly timeframes up first. We'll just leave the drawing set on for now. For the most part, this structure is extremely similar to the S&P. No acceptance in the prior monthly bar here. Really weak close at the lows, right on the 50 SMA. This is underneath our prior pivot from up here, and we've also got a new monthly close underneath here, so that does strike me as being more bearish. If we take out our Fibonacci's from the sickness low all the way on up to the top, you'll notice that we are firmly underneath the 50%, and the 61.8 is a big deal. The 61.8 is a big deal. If you've been around the channel for any period of time, you basically know that the more we can close bars underneath, the higher the chances are that we do see that 100% retracement. Now, again, that doesn't mean that in the month of October, we do something like this. It's just a awareness thing that the 61.8 fib is basically right underneath us. It's coinciding with the weekly expected move low. I can just kind of see that green dashed line in there. So anyways, continuing on down to the weekly time frame. Here we go, and let's remove those fibs. There we are. Same idea as what we just discussed in the SPY. No need to rehash that. We are underneath this kind of level right here. If I throw on the volume profile, it's going to show us that we are threatening to move into a big volume pocket just like the S&Ps, but notice that your next high volume node's really closer to 200, not the pre-sickness highs. Okay, so just be mindful of that. Another awareness thing here on the higher time frame charts. This has not really extended too far past. It's 100% retracement on the weekly. And if we go down to the daily and throw, we want to throw our study set back on. Thank you guys for bearing with me, by the way, through some of these change in study sets, so on and so forth. I really do appreciate it. And if you've enjoyed the video so far, a thumbs up goes a long way. A comment down below goes a long way. It just lets me know that people are interested in these videos and my perspective here. But anyways, the QQQ balance range, right? Obviously failing on Friday, just like the S&P 500. The numbers that I would want you to pay attention to are that if we can continue to break down underneath 267.50, we're coming into 261.25 and 256.65. That's the lower edge of the weekly expected move, but also a prior level. It's probably very faint on your screen, but there is a gray line that extends this way, indicating that yes, we do have a number there. On upside, if we do rally, you're looking for back tests of 272.65 to fail for your lower high on the daily. And if we can close back above, that does start to trigger your look below and fail. Oops, wrong tool. Here we go, look below and fail, target the top of the range, which is the weekly expected move high, roughly around 277.85. Technically, the top of the range is 279.54. So that's your QQQ. The psychology, is the same exact as the S&P, and those are your updated levels. Taking a look at the IWM Russell 2000 and the small caps monthly time frame first, nasty inverted hammer, no acceptance in the prior monthly range, close extremely weak at the lows. This is much more of an expansive move than what we just saw in the Qs as well as the SPY. Obviously, we are just at the June lows. We've got a new closing low, but we are just at the low of June as well. We are not through that in the IWM. We're also at the Great Reset already, so that does not really strike me as all that important of a level to be watching for as support now, right? If we come in from, let's go to the wick high, there we go. What you'll notice is this kind of is the 50% retracement. We're obviously underneath the 38.2, but not quite at the 61.8. So Russell's kind of an outlier, just in between, I would say, relative strength and relative weakness as compared to the SPY, right? So that's your monthly time frame. Does strike me as being more bearish than bullish, but overall, be mindful that we could see a little bit of a dead cat bounce off of just general support area right here. Drilling on down to the weekly, we'll kind of keep it brief here in IWM. Inverted hammer, nasty, does look like it can move lower. The structure here is clearly different than the other broad market indexes that we've seen so far, this to me looks like more of a failure to accept in the range and a pretty tame close. So breaching these lows can unlock some downside after experiencing a little bit of consolidation, perhaps better illustrated on the daily time frame. Here we go. There's your balance area. It has not broken down yet in the IWM, so the trade here is quite clear. It's just breaking out one way or another from this balance box that we're stuck in. That means underneath 163.25, 162 opens up the can of worms to the downside, and your downside target is going to be the lower edge of the weekly expected move, 158.15, and also an unfilled gap. Again, it's probably pretty faint on your screen, but we do have an unfilled gap from the weekly expected move down to roughly 155.70. Upside moves. If we take this out, then maybe you could make the argument that that kind of acts as a double bottom neckline, but that does seem like a little bit of a stretch of the imagination coming into this upcoming week. The number is going to be 171 even. 171 even is your breakout to the upside for a back test of 177. But again, is it big steps in the upward direction if we make it to 177? Not really. This just strikes me as a failed bear flag. We move here. There's a high probability of a lower high given the daily trends out there in the market. So that is the broad market. Thanks for tuning in with me. Here goes the core list. You've made it to this point in the video. I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that, we'll jump directly into Apple. Keeping it brief through the core list. Obviously, this is not a great location for a new money short. Instead, what would I be watching out for? If we can rally early on in the week, first rejection point for a lower high is possibly 142.65, and then the infamous backtest of 147. I would look to position for shorts against those two levels if the intraday market conditions present themselves, aka inverted hammers, double tops, head and shoulders around either of those two levels. If we do continue lower out of the gates, I would watch for an oversold bounce off of 134.50 or 132.50. Next up, we've got Netflix. What's going on over here? Actually holding up quite nicely in this overall daily balance range. It's also above its 234. Remember that was a range within a range, and we're starting to put in a higher low pullback. Can we reverse back to the upside? Your breakout trade is into the gap overhead at 250. Guys, it's 80 points overhead. You don't have to be the first one in the door. You can wait for a new uptrend to build over 250 before looking for new money longs. On Friday, we did print an inverted hammer, so I am slightly concerned about 234 holding, but one step at a time. In here, neutral, bullish, and bearish underneath 234. Simple as that. Inside of Netflix, be mindful of that inverted hammer. Here comes Tesla. Big breakdown of the two-day range, also failing to get back inside of this range here on the rejection of 287.50. So going forward, again, inverted hammer on Friday would suggest a failure to accept back within Thursday's range, the breakdown range. If we stay underneath 267, that is the optimal bearish outcome for a move into this gap underneath us, 255.06 down to 250.47. That is the gap fill, and anything underneath that really takes us closer to 241.25. The chart does look bearish based on a lower high being put in and the inverted hammer from Friday. Only looking for bullish outcomes if we can get above Friday's high at 274.40 and put in a higher low above it. Next up is Google. What's happening in Google? Again, just ugly trend to the downside, really choppy through here, pretty difficult to participate in. But on Friday's session, failed move to the highs, close underneath the lows. I would look for some bearish outcomes here in Google into 94.10, 92.15, and 90 are your downside levels. Again, I don't think that it goes there in a straight line, but over the course of time, those are the areas to be paying attention to. Bullish outcomes can only be produced over the two-bar highs here at 98.75 for a scalp only into Wednesday's high at $100.75. If the chart's going to see a larger turn to the upside, I would want to see a higher low above 175 cents for something that looks like this to start to feel more confident about longs into the future. But as of right now, obviously bears are in control with that failure on Friday. Meta is going to look pretty similar, but the balance range is a little bit more contained down here. So you're watching for a breakdown of 134. Obviously, you've got your inverted hammer. So a breach of that gets you to 128.75, 123.85 is after that. The only time to be bullish in this is a move and higher low above that high for possibly looking at these levels. Overhead 150 strikes me as the target that you would kind of need to target for the risk reward to make sense. And obviously at the 155 level, that's the big back test of the daily range from here. So one step at a time. The chart certainly would not suggest that we're headed there into this upcoming week. Next up is NVIDIA. What's going on in NVIDIA? Taking a quick look at this one. I know these charts are getting pretty tough to look at in the bottom right-hand corner, so I'll do my best when I remember to open them up and look like this. Regardless, NVIDIA looked back inside of the overhead range. Massive upper wick failure on the Friday session, closed back weak underneath the 122.50. I would look for bearish outcomes underneath 120 early on down in the upcoming week for a rotation into 117.25. After that, we've got 114.20. If it's going to be bullish, you guys know the deal. It's got to take out the top of this balance range at 126.85, just like the broad market. Next up, we've got Microsoft. What's going on in Softy? Taking a quick peek, zooming in. I know the charts are pretty ugly, pretty darn ugly out there. Here we go. So breakdown of the flag range. That does strike me as being bearish. We are looking for some continuation. This is day one of the breakdown. So 230.60 is your first hang-up point. After that, you've got 226. I do not think that 216.15 is on the table for this upcoming week, but just be mindful of it as a lower level. If it's going to be bullish, this can experience, unlike what we just saw in NVIDIA, a look below and fail. If we move back above 235.10, target the top of the range here, 241.30, and then possibly the 247.65. Again, trying to be very open in terms of outcomes into the upcoming week, not wanting to get caught on the wrong side of this volatility. Let the market, let the charts tell you what the stocks want to do, what direction we want to head. Are we taking levels out? Are we not? Are we getting confirmation? So on and so forth. Last but not least, the mini beast. Here is your flag. Again, failure on Friday to move above the top of the range there at 116.50, and instead we're looking for now a breakdown underneath 112.50. That would seem reasonable to me given the structure here and the fact that we're still in the flag to get some continuation to the downside into 106.25. That's your bearish outcome. If it is going to be bullish, in the flag, fine, breakout here, probably watching for some confirmation of a higher low above 116.50 before getting all giddy about any upside inside of Amazon. So next up, 9 trade ideas. Quick reminder to just hit all of the buttons YouTube tells us to tell you about, and we'll dive directly into these 9 ideas. First up is on Uber, inside bar on the Friday session, printing as an inverted hammer, rejecting that upper wick. Break of the 2-bar lows at 26 brings us into the gap close here into 24.62. Not interested if we can't get into the gap in the first place. Next up is ConocoPhillips. COP is the ticker here, and this is exactly what we talked about in the energy sector for the gap fill trade overhead. It does look bullish with a little digestion doji on the Friday session. Not interested if we can't get into the gap overhead. Same thing is going to hold true in XOM for ExxonMobil. You've got your overhead gap. This one's a little bit more bearish with the red bar on Friday, but as long as it can hold up above, let's map this in right here, as long as we're above 87.15, putting in bull flag consolidation trade is still on the table to close the gap overhead. These are probably day trades. You want an intraday setup to get into those gaps overhead so you can use tight risk reward. Here we go on Dollar Tree, actually a bullish trade idea. Can you believe it here? We've got sort of, maybe a double bottom building out on something like a weekly or a monthly chart here. The main thing I'm focusing on is the fact that we've got 2 back-to-back hammers that looked underneath these lows and got, no acceptance underneath. So if we can take out this level here at 138.31, looking for the rotation higher into this next overhead resistance at 142.83. Again, probably using that as a day trading opportunity for a swing trader. You might want to aim for up here if you're going to use a stop underneath the bottom of this little island that we've got going on right around in here. Next up is ADM, Archer Daniels Midland. What's going on here? This is actually a bearish trade idea. So very similar in terms of how it might have looked, but overall, this is much more of an obvious descending triangle with inverted hammer on Friday inside bar for the breakdown of 80.31 to get you into 79. Again, for anyone looking for more than just a quick intraday trade, intraday scalp, you need to start targeting 76.65 coming from this gap close over here. Stop would want to be over the Friday high. Next up is Morgan Stanley. Remember what we said about the XLF as a sector overall, right? Bear flag is forming here with not a whole lot of support underneath us. You'll notice that on Friday's session again, we looked above Thursday's high, failed from the buyers, and we closed weak at the lows of Thursday, if not slightly underneath. I can't quite tell from this perspective, but regardless, a breach of 78.50 gets us bearish into, probably I would say you would want to start looking at your 75.62. There's a little gap down here, right? So that would want to become the target, and that also makes sense from a measured move perspective. That seems certainly reasonable from a bear flag outcome. SQ is going to be very similar. Right? Wednesday, obviously big failure to the upside. There was no, retracement of this thin structure whatsoever. We look above Thursday's high on Friday. We close weak underneath the low. That one's, definite for sure. And if we take out 53.90 to the downside, 54.33 is the actual level. If we take out 53.90, opens the door to the downside. I would just monitor this for continuation into the oblivion and not necessarily look to target any particular level. Next up is DocuSign, also a bearish outcome with the bearish engulfer on Friday. So 2 inside bars here, and we look above, fail, close at the lows, right? So watching for a breakdown of 53.30 to target the low in here at 51.14. And last but not least is a repeat from last week. We talked about snow on the long side with the little hammer candle that had printed here, but we've got to change, right? We change with changing market conditions. Look at the multiple failed attempts number 1 and multiple failed attempts number 2 on Friday to get up and over that 174.62 level. Trendline is breaching sideways through time, starting to look much more like a bear flag down here. So big failure on that upper wick is really what I'm reading into into. If we break down underneath 165 roughly, you're looking to close the gap underneath us into 160, and then your next level underneath is 153.26. There we go, as a downside target. So I know it was a lot. I know it was a long video. Thank you so much for tuning in. I really do hope that you appreciate these. And, I've had some small impact on your trading. If I have, let me know in the comments section. I love to hear those sort of success story from you guys. A thumbs up goes a long way as well. And with that being said, I wish you all a green trading week.